Hello, and welcome to another video. Today we are going to be talking about 7 myths that we have when it comes to investing in the stock market. I have a hard time saying that, myths. I can say myth, no problem, but when it put the S on, I don't know. I used to have a little bit of a list, but I think it brings that out in me a little bit and makes me feel uncomfortable. So I am saying myths, M-Y-T-H-S, but I don't know if that comes across to everybody. But I refuse to not say the word because of that, because of some weird insecurity I have. But we're going to talk about these investment myths that are out there and see if they're holding you back, and maybe tossing them to the side is what you need to get on your path to financial freedom. Welcome to any of you who've been there and watching regularly. I thank you. And for anybody who's new, hi, I'm Lisa. I've been an investment advisor for almost 14 years now, and I help people get to financial freedom and independence as quickly as possible, whether that means, early retirement, retiring at 65, 67, or meaning, I just want less stress. I want to be able to continue to work, but I don't want this stress ball of oh my gosh, I have to do this. I want that freedom of being able to do what I want, when I want, and not have money be an issue. And that's what we work on with clients. That is what most clients, I don't think I've ever met anybody who doesn't have that goal of just being able to do what they want when they want and continue to work or not. So, all right, so let's get started on some of these misconceptions. And I'd love for you to take mental notes, or if you're writing stuff down, great, that's totally fine. But are some of these things you believe and that maybe we need to toss to the side? And being actively involved in your own education and our own money mindset hangups that we have is really important. So, all right, so myth number 1 is investing is only for the wealthy. Now, I hear this all the time when it comes to working with financial advisors as well. That's for rich people. Rich people invest in the markets. Poor people don't do that. And I don't even know what their definition of rich and poor is. You could have $1 million and say that you're poor. I don't know what that means to anybody. So if you believe that you don't have enough money to invest, that's really not true. And that is really not true nowadays, because you look at companies like Fidelity and Schwab, you can set up an account and start investing $25 a month and buy Fidelity for sure. I don't think Schwab does, but Fidelity for sure has, if you wanted to buy a stock, you can buy partial shares of that stock, which means you can buy a part of Amazon, even if Amazon's like $3,000. It's not $3,000, I'm making up, but even if it's $3,000 per share, you can still take your $25 and buy part of a share of Amazon or whatever company you're looking at, right? So that has made it so much easier to get invested. Also, many of you have 401ks and things like that allow you to put away a certain amount of money every month to be able to do that. And sometimes it's $100 a month, sometimes it's $25. Whatever that is, it's better to start. I just did a short video on this. I don't know if it's out or not yet, but a short video on a survey that was done by money.com talking to retirees. And retirees say that it was 72% or something like that said that they wish they could redo their planning for retirement. And it was 75% said the biggest regret they have is not investing sooner, not getting started sooner in saving for retirement, which often includes investing in the stock market for most people as one of the ways to do that. And so if you come in with this limiting belief that investing is only for the wealthy, you're going to talk yourself out of investing at all until you hit 50, and then you hit panic mode, which most people do. And that's not a good sign. You don't want to do that. So start investing even a small amount early. So it's not for wealthy people. It's especially not for wealthy people now, because companies like Fidelity have made it so easy. Not sponsored by Fidelity. I just know them pretty well because I work with them a lot. but I work with a lot of different companies as well for investing. Okay, so myth number 2 is you need to be a financial expert to invest. This is daunting, right? Talking about different things, the difference between a mutual fund and an ETF and an index fund, and a stock, and how does this work, and what's your investment philosophy. I had a prospect come to me and I said, I would go back and ask your current person, because they weren't sure if they were happy with what was going on. I said, ask what their investment philosophy is. What is their investment strategy? And if they can't answer it, or if you don't like their answer, then you guys aren't aligned. And we take years building up our investment philosophies, investment strategies. And I would tell you that for me, it sometimes varies from client to client, because not every client's the same, obviously, and I don't treat them the same. So it can feel overwhelming, like you need to be some guru to invest. But there's so many resources out there for you. You could come to somebody like me and help with investments. We just broke that myth of you have to be wealthy to work with somebody like me. There's lots of different avenues that are out there now in order to work with people. But the other thing is that there are tons of portfolio models out there. If you probably just Google portfolio model, you will see that Fidelity has some, and Schwab and Vanguard, and all these other companies have portfolio models that they put together that make it really easy to see what they're doing, what funds are in there. A lot of them are proprietary. A lot of them are one single. So like Vanguard's only have Vanguard funds in that, which makes sense, right? Fidelity does have a mix of them, but their primary ones are all their Fidelity funds. Schwab has their Schwab fund. They all have their own funds too. But it's an easy way to look at some stuff and maybe choose one that you like. There's also robo-advisors out there. Robo-advisors can be great in one respect, because you can just pick, answer a couple of questions and then pick your allocation and get going, right? That is the one wonderful thing about robo-advisors. The bad thing about robo-advisors is, you don't quite know most of the time what you're invested in. They don't tend to give you a breakdown. At least the ones that I've seen or have had to review for people, not a huge breakdown of like what's in the actual robo-advisor fund, which could be a little off-putting for people. The other thing is you do have to be an active participant. I know they're like, it's robo, it can do it yourself, but you still need to make sure that it's doing what you need it to do. So you do not need to be an expert to invest, but you just have to be cautious of what you're choosing and try to educate yourself a little bit before you invest. I wouldn't say just, talk to some friend and invest exactly the way they're investing, because you don't know if that's the right thing. Myth number 3 is the stock market is like gambling. Now, I can see where people feel this way, because it feels like it, right? It feels like up and down and up and down and, all this stuff. But the difference is you're making informed decisions versus chance. You're taking a chance. Like if you're gambling on a football game, and I don't understand gambling that well with the spreads and all that. I've never done it. I don't understand any of it. But yeah, you could say, oh, I'm doing an informed decision because I know the quarterback and I know the coach and I know their strategy and I've been watching. I guess you could say that. But there's so many little blips that can happen. I watch football with my husband on the weekends. I'm not I'm usually doing something else and it's in the background kind of thing. And it's amazing how one little thing can just turn the whole thing. And it has nothing to do with an informed decision, right? And yeah, that can happen to a company. That can happen to a stock that you own. But the chances of that happening, especially for a public company, are much less, because they're reporting every quarter. You're getting some kind of sense of what's going on. Also, I would say, if you're owning one individual stock, yeah, it's going to feel much more like gambling. It's really going to have this roller coaster effect. If you are well allocated and have many different stocks or many different ETFs or mutual funds or whatever, and you're well allocated in that you have taken your risk and made it more diversified so that you've got maybe 1,000 stocks in there versus one, that takes out the gambling aspect quite a bit. It smooths the ride out for you. And does that mean like in years like 2022, you're not going to have a down year? Of course, that's not what that means, but it's going to make it easier than buying one single stock. That can definitely feel like gambling to some people. All right, so myth number four is high risk equals high reward. I would say, you know what, are you okay with it going to zero? And I have never had one person say no. Of course they don't want it to go to zero. I don't care if they put $50 in. They don't want to lose $50. And that is a high risk. And I would say oftentimes there's not a high reward, especially for small companies. Like the small cap market is really interesting, which means that they're very small companies that are on the market. They're public. They've gone through the IPO process, but they're much smaller. They're not the Apples of the world, right? Those companies are really interesting because they have the highest chance of reward, right? But they also have the highest risk. So if you look at they have an S&P, they have kind of a S&P 500 kind of thing for small caps. I'm sorry, Russell 2000. Russell 2000 is the index for small companies. It's 2,000 companies. And you can see the movement in there. It's just crazy the amount of movement that happens with individual companies. But as a fund, it actually can do quite well because you're capturing some of those highs. Like if I had only known Tesla before it went crazy, right? That's whatever. NVIDIA, if I'd only owned NVIDIA, that's the big one I hear. If we'd only owned NVIDIA before, I wouldn't have to be working. Clients say that to me all the time. I know they're joking, but still. That kind of thing, well, having part of the small cap market actually you can own part of it. You might not own it individually, but you own part of it in the fund and get some of that reward. And I would say that that's much less risk than buying the stock outright and just going, oh, I hope it's doing okay. I hope it's going to go in the right direction. You just don't know. And so, yes, high risk does not equal high reward. A lot of times, slow and steady wins the race. A lot of times, having consistent positive returns is what ends up building a really nice portfolio and a nice chunk of money for financial freedom than, necessarily going through this all the time. It's also a lot less stressful. Let's put it that way. Myth number 5 is you must have perfect timing. Timing of the markets is one of those myths I think a lot of people still have in their heads. Like, I have, especially some older clients, make jokes like, today's down, did you get some cash in? I'm like, you don't have cash in the port. Like, we've already invested it. What do you mean? Are you doing lots of trading for a down day? I'm like, no. Like, I don't understand. I guess I don't understand what the question is because I don't time the markets. I'm a professional. I don't time the markets. I think there's better days to get in than other days. But overall, when you're trying to time the market, most of the time what you do is you're sitting on the sidelines waiting to get in, and you've missed a lot of the upside most of the time. So we beat ourselves up about getting in at the wrong time. I had a client who put in a chunk of money and the market went down the next day, and he's like, oh, I missed it. I'm like, no, you didn't miss it. And 2 months later we were fine and completely forgot about it. This timing effect in the markets, it doesn't work for anybody. This idea of pulling it out right before the market falls out and pushing it in right at the bottom of the market, nobody knows how to do that properly. People know how to pull out of the market sometimes, but getting it in at the down is very difficult. There's absolutely nobody who times that properly. I don't care if they're the biggest hedge fund manager in the world, they don't time it properly. And so timing really can make people uncomfortable. And it makes sense because it doesn't work most of the time. So I do think that you need to slow and steady, big picture, that kind of thing. The timing is small picture thinking. It's 1-2 years thinking. I'm talking about your lifetime investing. And you will be much happier, much less stressed out, and probably hit your goals much better if we think long term rather than short term. And timing is short term. Myth number 6 is investing takes too much time. Now, I think that this is an old-fashioned myth. I think people, I don't get this as much, but I do think people are, I think this is paired with the I need to know a lot about investing to do it kind of thing, and it's going to take a lot of work because I don't know anything. I think technology has taken out this kind of hub a lot. Obviously, you can work with an advisor and they do all the work, so you don't have to worry about it. A robo-advisor does the investing for you. We've already talked about the pitfalls that can happen with robo-advisors, which is you have to be still pretty involved with it. But I think when people say, "Oh, it just takes too much time," it's the same saying that everybody says that drives me crazy when they say, "Oh, I'm just so busy. I'm too busy." It's just it's that same. It's an excuse. It's an excuse not to do it, to be frank. And if you think investing takes too much time, really look in the mirror and say, does it take too much time, or am I just not? Is it something else? Am I just afraid? Which it's okay to be afraid to invest. A lot of people are afraid because they don't understand it and they're worried about losing money, which makes sense. But don't say it's because it's taking too much time. That's not the truth. The truth is it's scary and I'm afraid to lose money. And that's okay. We need to get you over that hump. Give me a call. I'm happy to help with the money mindset stuff. But you just need to invest the way you need to invest. And maybe that's very low risk. That's okay. Myth number 7 is all investing needs to be constantly constant monitoring. So I'm hoping that people have stopped doing this, but I do still have those clients that are like looking at it every day. And I tell them, I don't know why you're looking at it every day. That's too much. That's too much. Look at it once a month, every other week maybe is okay. But once a day is too much to be looking at your portfolio. There's nothing you can control day to day. Right? Fed comes out and says, Jerome Powell says something, the market goes tanking because he says something that is ridiculous and doesn't mean anything for the future of the stock market. It's just, an excuse that people use to take some winnings and stuff. And, if you look at that day, you think the world is falling apart. And then you have days like we just had the election and President Trump's going to be back in office. And whether you like him or not, the stock market went soaring. I mean, soaring. And, I think this happened the last time. I can't remember, honestly. Markets move so much, I can't remember some of this stuff. But markets were soaring recently, and I had clients being like, oh, look at how much it shot up, and maybe I didn't vote for him, but I'm certainly happy with what's going on in my portfolio, or whatever they said. I heard that a couple of times. Don't monitor it that much because you're going to have these huge highs and these lows, and just because it goes to a low does not mean it's, the end of the world or we're hitting, Great Depression again. So I do think we monitor the investments a little too much, because when we're doing that, there's two things that are happening. One is we secretly know we're not saving enough. When you're so focused on the rate of return, it's because you know that you are not saving enough. I always say the thing that you can control the most is how much you save. And if you're not saving enough, you're reliant on that rate of return. And we can't control rate of return. You just can't. You can think about it, you can make wise decisions, but you can't control it. I mean, look at 2022, the bond market had historical lows, and nobody expected that. That had never happened before. You cannot control rates of return. You cannot control downside. You cannot control, that's why the whole thing is, we look at historics, but that obviously doesn't predict the future. You see that in all investment materials, because that's the truth. It's the truth. And so, you know, you've got to really remember that this is a long-term game. And what you can control is how much you save, liquidity, how you're going to pay taxes, those kind of things. You know, not what you're going to pay in taxes because you can't control that other than your vote. That's it. That's all you can control. And so this constant monitoring just creates panic in people, or watching one. I have clients that do this, that will watch one fund and say this one fund is not performing like all the other funds, because it's not supposed to. It's supposed to be counter-cyclical to the rest of the portfolio. And they get very focused, and it's like they don't listen to that, and they just keep talking about this one fund. And all, you know, I say, look, we can take it out, but I think that's the wrong move. And then as soon as we take it out, what happens, right? The fund goes up like 6 months later, and then they're upset. And I say, well, that's why I said don't take it out. But anyhow, it's not always the case, but it's just one of those things. I think when we look at it too much, we can talk ourselves into something, you know, something that's maybe not right for us in the long run. So those were 7 myths, and we have busted them, right? They are gone. We are not going to let them cloud our judgment anymore. We are going to get investing if we haven't. We are going to be focused on investing if we have invested, but we just haven't been focused on it. And knowing that most people use the stock market as part of the way to grow their funds for financial freedom, the stock market's important. And we do not put enough emphasis on having some kind of understanding or constant dialogue about how to invest in the markets. I think we should. And I think these myths and getting rid of them can be your path to that. So until next time, take care. Hope everything's going well. We're getting into the holiday season. Don't spend too much, but it's okay to spend and enjoy time with family. So until the next video, take care and bye-bye.